What's up, guys? We're gonna get everybody about till 8 o'clock, and then we'll get started here.
Damn, it's 8 o'clock on your end, bro.
Yeah.
Damn, bro. I just came back from lunch.
I go to bed after this.
Dude, I still have like a half shift to go.
That's crazy.
All right, I'm at work, so I'm just gonna listen in.
All right, sounds good.
Yes.
All right, we're gonna get started here. It's 8 o'clock. Let's get started. So we'll just let people join us as we go. But so basically, what we're gonna be talking about today is reversion to the mean. I'm sure a lot of people don't know what that is, what it looks like. But this is a concept that kind of everybody needs to know. So when we're looking at these times here, when we reach, so these are the Keltner channels. So basically what they do is average, or they measure the average true range of stock. And they kind of give you an idea when we're too far extended. Personally, I think they're way better than like an RSI, things like that, because they give you the average range a stock moves. So these inside bands right here, so this one here and this one here, show the average range a stock typically trades in. This 21 EMA right here, that's the one that I use here, 21 EMA, is I consider the mean, the average that we always typically come back to. So that's what I typically watch for. And then we have these two outer bands, which are considered to be like a little more extended. Usually these ones will be ones that you'll want to do like profit taking around this area, right? You're not necessarily going to want to get into trades once we get out to this area, unless you're looking for a move back to the mean. So I kind of call this 1 ATR area a buy zone. And this is kind of the area that you want to get into a trade, expecting it price to expand to these outer bands out here. Once we get to this 3 ATR level, you can see we pretty much never go outside of it. It's very rare. Like, for example, here, as soon as we did, we reverted right back to the mean. We went straight back to the mean, actually flushed to -2 ATR, came back to the mean. So kind of the point that I want to make here is that stocks like to revert to the mean no matter the time frame that it is. And the mean I typically run with is the 21 EMA. The 20 EMA probably isn't much different. It probably doesn't show too much of a difference, but the 21 EMA is just the one that I like to use. I find it to be the most beneficial. So if you're looking at the Keltner channels, these are kind of the setup that I have. So basically what I have is you just type in on TradingView, whatever platform you use, Keltner channels, and then it will pull up. You'll add it to your chart, and then to edit the lengths, this will already be at 20. just flip it to 21, and then you add 3 of them and do a multiplier of 1, multiplier of 2, and a multiplier of 3. So this is the multiplier of 1, this is the multiplier of 2, this is the multiplier of 3, okay? And so those are the basic Keltner channels, right? That's basically how they're set up. What they measure is the average range a stock will move. If you've heard of average to range, it's very similar to the idea of the market makers pricing in a move for options contract. Like, for example, when someone says the expected move, this is the similar idea. It measures the average range over the past 21 bars for whatever time frame you're looking at, and it expands it by 1 multiplier, 2 multiplier, or 3 multiplier. Okay, pretty simple, pretty easy stuff, right? Okay, so now what we're looking for is what we're looking at is the concept of reversion to the mean. And you can see how consistent this is throughout all of trading, right? For example, we take this 4-hour time frame of NQ. You can see how many times it reverts back to the mean. So when we're looking at this, we'll go here. So take a look. So we go from the mean out to 3 ATR, make it back to the buy zone, right? So that's what we're looking for all throughout this. So when you look at price and understand, like, for example, this here, when people are buying breakouts, they're usually buying euphoria, meaning like, oh, they're imagining how much money they would have made if they would have got in somewhere down here, but actually they confuse that feeling with entering somewhere up here or up here for that matter and just get screwed. They take the break out of this level right here. Once they do, they just get destroyed. Okay, so this helps you with getting out of the mindset of getting caught in euphoria, trying to chase trades, right? The best way to avoid chasing trades is just enter within that 1 ATR. You're entering within the average true range the stock moves, the average range the stock moves. Okay, so now when we look at this, you can see how consistent this pattern is. So we'll just go back in time, right? This is pretty choppy around here, but you can see down in here to the mean, or from the mean to 2 ATR, to the mean, 2 ATR, to the mean, 2 ATR, to the mean, trade alongside, 2 ATR, back to the mean, 2 ATR, back to the mean, 2 ATR, flush to the mean. Oh wait, we turn downside, minus 2 ATR, back to the mean, minus 2 ATR, so on and so forth. You can see how consistent this pattern is. It pretty much just does it over and over and over again in stocks, right? Very consistent pattern. Okay, if we go and look at this at other time frames, right, or further along, it doesn't just happen in this one piece, right? So like, look, at the mean, flush to 2 ATR, 3 ATR, back to the mean, didn't quite make it there, but we flushed back to 2 ATR, back to the mean, chopped around for a bit, up to the mean, or sorry, up to 2 ATR, back to the mean, up to 2 ATR, back to the mean, change trend, down to 2 ATR, kept flushing, continued to hold, but you can see this wasn't a very good move, back to the mean, 2 ATR, 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 back to the mean, went a little above, and then what do you know? We're back to 2 ATR. And this pattern continues over and over again, right? And so when we look at this, you can see what happened on these other charts here, or what we're looking at current time. Now we're outside of 3 ATR, or when we got to 3 ATR, we flushed back down hard. We dropped, let's take a look. So from peak to trough, right? We dropped 661 points. Now, for the NASDAQ futures, if you equate this into, equate this back into like dollars in QQQ, this would be, so I'm not going to get my calculator out, but every 40 points is roughly $1 in QQQ. So we dropped 657 points. So that's a $15 move, right? So that's obviously an extreme example, But notice all that we did was we went from the mean. Actually, yeah, went from the mean to 3 ATR, back to the mean, flushed down to 2 ATR, back to the mean. And now we chopped around a bit, and then we have our move up to 3 ATR. So what's probably going to happen here? If it's a really strong market, what we'll see is some consolidation and then another move higher. If we are seeing anything like this story that was written just a few days ago, we're probably going to see the same story of a reversion back to the mean. So that's kind of, so this is a way that you can keep intact with what's going on in the markets. It gives you some guidelines on where we sit in the markets, right? And so, like, if we look at this here, for example, we look at this, you can see these price action moves, like where we had a spike here. Probably a lot of people got in calls, but here's a few pointers. So this one was a normal move within the stock. Like, we moved up back to the mean, we pushed above it, but we stayed within the normal range the stock usually will trade in. This is average for us. Okay, that's an average range of the 4-hour time frame. Okay, now you say, oh, maybe you brought up a really good time frame that shows this on a really good time frame. Okay, let's go to the daily time frame. Okay, same thing here. Look, to the mean, 3 ATR, back to the mean, 3 ATR, strong market, back to the mean, 2 ATR, back to the mean, 3 ATR, back to the mean, broke below the mean, flush to 2 ATR, back to the mean, and now maybe we'll make our push to ATR, or we'll stay in this average 2 range and bounce around for a bit, or we can bounce back down to minus 2 ATR. So right now, we are in the average 2 range of a daily time frame for the stock. So it's very, very common to see this. Let's go look at the weekly time frame. Okay, weekly time frame. So we'll start back here before we got in this bear market, right? To the mean, 2 ATR, back to the mean, 2 ATR, back to the mean, 2 ATR, back to the mean. I can't see that, it's in my way. Oh, we didn't make it quite to 2 ATR there. But once we started the bear market, 2 ATR, back to the mean, 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 stayed within the normal range of the stock here, and then eventually pushed up to 2 ATR, 3 ATR, strong market, back to the mean. So you can see this is a pretty consistent pattern that goes all throughout stocks, indexes, the market, right? And you can see this play out on really any ticker, any stock that you're trading. Like, look at this is the dollar. Mean, 2 ATR, back to the mean, 2 ATR, back to the mean, 2 ATR, back to the mean. Now we're chopping around in the average range of the stock, right? Pretty consistent pattern all throughout the markets that you may look at. So really, this can be used on Forex, this can be used on futures, this can be used on stocks, commodities, whatever you want to trade. But the concept of reversion to the mean can be useful in all the things that you're looking at, like all the different types of trades that you're looking at and looking to trade. So, like, for example, I let the chat know, the signals chat yesterday, I thought we were going to rally partly, and because we were at 2 ATR and we needed to come revisit the mean. Now, we didn't get that all the way, but I still had this right idea that we should go long equities because the dollar was probably going to fall because it kept rejecting 2 ATR. And then sure enough, we did. We had our move down. And that's how you can kind of use this in Confluence to understand, like, what is too far gone? Like, what is extended? What is too extended? What's trading within a normal range? What is not extended, right? Should I be entering this now? Sure, it's going to work sometimes like this here, but more often than not, you're usually catching the tail end of the move, like here, like here. What was that? Somebody's drawing on my screen. Okay, well, and then Same thing here, catching the tail end of the move. And it's just pretty consistent. You can see it throughout. You're catching the tail end of the move if you're buying outside of that buy zone. Here, tail end of the move. End of the move. End of the move. You're good, no problem. You're just catching the end of the move a lot of the times. So that's what you need to realize when you're looking at this. You're catching the tail end of whatever you're trading if you're buying outside of this buy zone or entering outside of the buy zone. Sometimes it'll happen. Now, what I'll recommend is like if you just feel like you absolutely have to get into this trade and you're outside of this buy zone here of the 1 ATR or the 1 Keltner channel, then size for 0. That's what I would say. Size for 0 and then see if it hits. Like for example, I was looking at this play here on SPY yesterday, right, and decided to wait on it. You can see here we here's 30-minute. Yep, we gapped up here, and calls looked good here, but we were at 2 ATR. So you could have entered, right? And then, but you would have just had to sit through some chop, and then it ended up paying off. But a lot of times you're missing the move, you're getting in there, and especially if you buy 0 day to expiration, you're probably going to end up missing that movement unless we have something super explosive like this today, when we had consumer confidence come out. Okay, so here's just this is another time frame. Now look at this. We had a move outside of 2 ATR or 3 ATR, which is pretty rare. And when we did, we snapped back to the mean pretty quick. Everybody was bearish. Like we had a strong downtrend for so long, and then we had a push back, and then boom, we snapped back to the mean as soon as we got to that overextended point. Another example that I saw as of recently was Tesla. Notice we gapped down outside of 3 ATR, and then notice the move we had after. Pretty crazy move after. Now look at this here. We're outside of 3 ATR on 30-minute time frame again. But notice here we got 3 ATR, here outside of 3 ATR. Now I'm not saying short this, but I'm saying when you get to that point, and if you're in if you're in puts here, and then we get to here, that's what I would kind of consider like, okay, maybe I should take some profits here, right? Like maybe I should call it good here, or like get out of a majority of my position. So this is more of this is something to help you stay in line of entering trades, exiting trades, so on and so forth. This helps you kind of stay in line with what you're doing, so you don't get caught in euphoria buying breakouts that are too far gone, or going short when it's already too extended, or holding on to winners too long. Sometimes you'll take profit too soon, but the consistency is the point that I want to make. The consistency of these patterns, you can see I'm showing them all throughout these different time frames. They show a pretty consistent pattern of replicating the same thing over and over again. So yeah, I mean, that's kind of really it. Like I wasn't expecting this class to go long, but I just wanted to get this idea across using the Keltner channels. They measure the average true range of a stock. If you're looking for what average true range actually is, you can get this indicator on your chart. All you got to do is type in ATR or average true range, and then it will pull up this chart right here. And this tells you the average true range. So like right now, Tesla on a 30-minute time frame, the average move for this stock is $2.38. What about entering a long or a short position on the third line? That would be considered a reversion to the mean type strategy. So like you're looking for it to revert back to the mean from where you were at. In my opinion, it's not the best quality setup, because like if you look here, when we're in a downtrend, would you rather get in here and ride it down, or would you rather like try to catch this and hope it goes back to the mean? Like this, basically you're trying to fight the trend by entering that way. So I don't do that personally. I know Dark Knight does that a little bit. But I think the bigger moves come from getting the explosions away from the mean, like getting the moves that go away from the mean. Does that make sense? Okay, cool. All right, guys. Well, that's pretty much all I had to show. If you guys don't have any other questions, then that's pretty much it. And I would say we're good to go. So I hope this helped. Do you guys have questions or are you good? All right. Well, cool. And if you guys are in the signals chat, I have a really in-depth video where I go over the Keltner channels in the OT education tab, where I go into those a lot more. But this was more of a understanding of the reversion to the mean versus understanding the Keltner channel. So if you want to check that out, make sure to go to the OT education tab in the signals chat and go from there. But thank you guys. Thanks for coming. Hope you have a good night. And I'll see you for the markets tomorrow.